Thank you. Thank you very much for this invitation to discuss this interesting paper. I will now share my screen. So I really enjoyed reading the paper. This is a very clear analysis with an interesting idea. So the paper presents evidence that countries with higher central bank independence have a higher level of reserves, and give a simple explanation for that. Governments are more impatient than the central bank. So Rogov said you should appoint a conservative central banker. Well, Agustin says you should appoint a patient central banker. That's maybe the main point of main implication of the analysis. So then there is a theoretical model that describes the mechanism based on a model by Alfaro and Kanzuk. And then there is a calibration with a quantitative assessment. So overall, I think this is a very neat paper, nice fact. I mean, fact I didn't know about, nice idea. So pursuing this and showing this in the model is really nice. And well, this was part of your PhD thesis. So this is impressive. Now here, we are at the conference, so I will be a bit well, critical, or at least question some of your analysis. But in general, I would say that the question is interesting, because at least in macroeconomics, so why do we hold asset and debt at the same time? And this is a general question that occurs very often and is difficult to model. For example, firms have large corporate debt, but at the same time, they hold a large amount of cash. Here, in the case of the consolidated government, a consolidated government issues debt, but at the same time as assets. Now, as is actually well described, and the literature review is very nice in the paper, most of the literature tries to justify the holding of reserves by precautionary or liquidity motives. In this paper, this is different. It's not about this precautionary motive, but it's about the presence of heterogeneous decision makers, in particular, well, in that case, the government that is different from the central bank. Now, the basic mechanism, well, both the government and the central bank optimize, they want to optimize consumption, the present value, but they have different discount rates. And the households are hand to mouth. There is an endowment, YT, and the central bank can reduce what is available to the household by this inflation tax tau, while the government can increase this consumption by transfer T by issuing debt. So if you have an impatient government, the impatient government will send a transfer to the consumer to increase consumption, especially in the initial periods, and increase debt. Now, the central bank can undo this by increasing tau pi and then accumulating reserves. So in that case, you can have both the central bank and both the reserves and the debt coexisting. If the central bank and the government are the same, well, then they will not take different decisions. But now you have two instruments. You have a tau pi and T that are decided by two different institutions, and therefore you can have this separation, and you can have debt and reserves. So that's the basic mechanism. And this is different from Alfaro Kanzuk. So again, it's a different perspective and different from most of the literature. So here, the reserves, they matter in normal times. And the main role of reserve is not for crisis. Of course, it could also occur in crisis, but the fact that it also matter in the deterministic case shows that it is not key to have a crisis. Maybe the crisis can help having a constraint on government borrowing, but in my view, well, so it's not key. So I ask myself, or I ask Agustin, do We need a debt crisis to illustrate the mechanism. But let me make some comments. So I like the paper because it's it's simple, and then the analysis is transparent. So I really like simple models. But of course, when we simplify, we take strong assumptions, and the question is whether well they are reasonable or not. So let me mention some of these assumptions. I will focus on mainly one, but let me mention some assumptions for the central bank. First, in terms of description, is an independent central bank really smoothing household consumption? I don't know, well, at the Central Bank of Chile, whether this is what whether this is the main objective, or there could be other objectives, and why is it a reasonable assumption to focus on that objective? That's purely about. I don't think this is a key assumption for the analysis. A second assumption that, I mean, well, made me think a little bit is usually central bank reserves are matched by liabilities. So you cannot just use these reserves because then they are like deposits by banks, etc., rather than taxes. So it would be interesting to know whether this is important or not. I don't think so, but still, this is not totally the way it is in reality. And third, well, independent central banks, they can also buy domestic government bonds. So in this model, if the central bank could buy the part of the domestic, the government debt, it could do the same thing. So it's not totally clear why there would be a preference for foreign assets and therefore reserves. By buying domestic government bonds, there would be no reserves. Now, so these are some assumptions I'm questioning for the central bank. And then for households, I think there is one assumption that to me is key, and the fact is that they are hand to mouth. So there's no intertemporal decision by the household. They cannot hold debt or foreign assets. So all the international asset transactions are done by the government or the central bank. So this is not really an open economy. I would call it a semi-open economy, or financially closed economy. The private sector does not have access to the international capital market. It's only the state. And in that case, the analysis, well, is different, because the government and the central bank will actually help or do the intertemporal trade for the households. The households, they cannot do intertemporal trade with the rest of the world, but the government or the central bank do. And actually, we had a paper with Kenza Benima and Yannick Kalantzis, where we analyze exactly that. A semi-open economy. This was motivated by the Chinese case, where the central bank is a Ramsey planner. So in the semi-open economy, the households are not able to do intertemporal trade. And there are circumstances where it is optimal for the central bank to hold reserves because it substitutes the household. The household cannot do that. So for example, if households are patient, they want to save initially. Of course, in this model, in the semi-open economy, they cannot do that, but the central bank can do it. This would be what the Ramsey planner would do that to optimize consumption. Or if you had an initial government debt, no, this might not be optimal for consumers, and then in that case, then the central bank can offset that just to undo the distortion or the deviation from the optimal behavior. Just to mention, in our model, the reserves, the counterpart are deposits by households. Maybe that's not a key assumption. So this hand-to-mouth assumption is the key assumption. If households could buy foreign assets, they could offset themselves the increase in government debt in transfers. So if the government is impatient and gives a big transfer to the household, and the households could undo this by buying foreign assets. You have no need for the central bank reserves. Here, the central bank reserves, they are here because the households cannot buy it. This was also, there's a related paper by Davis, Fujiwara, Huang, and Wang, where they show something similar. It's kind of a different model, but they also have a central bank as a Ramsey planner. And they show that if you have open full capital mobility for the household, then the central bank reserves are useless. But if you cut this, you have a semi-open economy, then the reserves start to play a role. So the accumulation of reserves play a role with restricted capital mobility. Or I think if you have a strong deviation from Ricardian equivalence. Now here, if you get a large transfer, well, if you have Ricardian equivalence, you're going to save more. But in this model, you cannot save. Right? Households cannot save. So this breaks Ricardian equivalence. So central bank independence should be accompanied by capital controls. Actually, in our paper, that's what we argue, is that it's optimal to have capital controls and the government accumulating reserves. Now, it could be that in Latin America, there's not complete capital mobility. And then there's a role for the accumulation of reserves. This is the line of Davis. In the Davis paper, they say, well, maybe emerging markets, they don't have full capital mobility, and therefore there might be a role for the accumulation of reserves. But it's because it's in the cases where you don't have full capital mobility. So that's my main comment. So I think it's a nice paper with a very interesting idea. The mechanism relies on very strong assumption. I think that the fact that there is no private sector capital mobility is something that is very strong and should be mentioned more explicitly by Agustin. At least mentioning this paper by Davis, they have this equivalence between they analyze the optimal role of reserves. And that's something that should be made more explicit. But I think if you had a really open economy, then the results would be different. This would they might break down. That's at least in the deterministic case. So as a kind of final comment, since I am in Switzerland, where the level of reserve is huge, it's more than 130% of GDP, while the level of debt is low. It's about 40% of GDP. So there's no kind of a direct link. But there are issues related to political economy, where the central bank independence plays a role. And the fact that the Swiss National Bank is very independent allows it to hold a large level of reserves. If it were less independent, the political pressure to use these reserves for all possible ways would be difficult to resist. So this political economy, I think, could be something to be added to the analysis. But again, I enjoy the paper, but there are a couple of assumptions that should be made more either explicit or could be discussed a bit more. Thank you.
Thank you very much, Philippe. I have a question from Georgia Bush. Does the government choice to default affect this central bank cost to purchase foreign reserves? And before giving the last word to Agustin, I have a question from Roberto Changos. Roberto.
A very nice paper, very interesting. I like the discussion very much, but I wanted to propose a slightly different perspective that Agustin can use revise the paper or to write a different paper. Because, I think that the intuition is quite clear once you look at the model from the perspective of having 4 relevant discount factors here. Okay, there is the discount factor of the domestic representative agent, the discount factor of foreign agents as represented by the world interest rate, okay, the discount factor of the fiscal authority or the government, and the discount factor of the central bank. And essentially, you're playing very much with those, right? What do I mean with this? I mean, imagine that, for example, the discount factors of the domestic agent and the world interest rate are the same, right? In that case, we know the solution in general is that there is an indeterminate level of debt. Now, what you're doing is to say, well, there is this government that is more impatient than those two, right? So in that situation, but that government has is the one that makes the decision of how much debt to take, right? So we know that in a model of incomplete markets, that kind of government is going to choose too much debt, right? It's going to drive eventually the economy to the credit limit, right? Now enter your technology for accumulation of reserves, which is costly, but on the other hand, you're endowing the central bank with a discount factor that is lower, right? You have a more patient central bank that therefore, the central bank is going to undo what the fiscal authority is doing, the fiscal authority distortion. I think that's probably the best way to look at it. Now, this story actually is a story about degrees of impatience. And then you might want to ask, well, what does it have to do with independence? Well, generally, we see independence as a way to kind of like give the central bank some kind of authority to make decisions. So we appoint the central banker, right? And that brings back the point that Philippe made at the beginning, but didn't develop, the Rogoff point. I mean, in some sense, the argument should be the same as the central bank conservative central banker, right? But then you can ask the question, well, what is the optimal discount factor for the central banker, right? In fact, in this model, I would actually conjecture that the central banker should be more patient than the representative agent, right? So that the central by choosing a central banker that is very, very, very patient, then you can actually bring the economy back to the first best. I think that would be something that you might want to explore in your model. But more generally, this is a very nice paper. I enjoyed that, and I think that you can do a lot with it.
Thank you very much, Roberto. I think we have 4 or 5 minutes for Agustin to answer all the comments and questions. Go ahead, Agustin.
Okay, thanks a lot, Leonardo, Roberto, Georgina, and Philippe. I think I need 30 minutes to answer everything, so so I'm happy to talk more about this with you. So just let me go quickly to some points. Yeah, Leonardo, I think you mentioned a very important point that maybe I am not highlighting this effect of reserve and reserve accumulation and debt accumulation in the bond price, which is the key for the mechanism. So I'm happy to include this in the paper, so to make it more clear. I will say, I mean, all that you mentioned is basically what I suggest, but it definitely I am not showing that. So that's something that I really can. I mean, I can do it, and I just need to include in the paper. So let me let me talk a little bit about the quantitative part. That I think that for especially is true. For example, something that you mentioned at the end is that you don't think it's a good idea to derive this reserve rule implied by my model. And I agree with you. Actually, this is something that in the new draft I just take off. And the reason is because to take this to take the quantitative results really serious, I think it's very important to add long-term debt. So that's something that I will definitely have in my agenda, and I would like to do it. Also, you mentioned something about the calibration with the debt service instead of targeting the long-term debt. I mean, it is true that when I do this, then the level of reserves that can be rationalized with the model is lower than the one that I have right now. But it's still true that it is possible to rationalize simultaneously positive levels of reserves and debt, which is I think is still a good theoretical point. And I will say that, yeah, that overall, I think that this is the main contribution of the paper, to shed light on, okay, we always think about the government as a consolidated entity, but does it really work as a consolidated entity? What if we relax this? So I'm happy to talk more with you, Leonardo, about all the other comments.
Can you clarify also Leonardo's comments about the difference between independence and commitment? I thought that your central bank is not only independent, but also has commitment not to default. Maybe I misinterpreted this. I think this question is also related to Georgina, who is asking how the price of debt paid by the central bank changes with the accumulation of reserves.
Thank you, Martin. Yes, sure. Yeah, as Leonardo mentioned, I mean, in the model, independence doesn't meet commitment, like the central bank. I mean, the central bank do not default here because also they are not accumulating any debt. So basically there is, I mean, but they can they can reoptimize like in any period. So I am not implying commitment here. And related with Georgina, the way that the government can affect the cost for the no, sorry, the government choice to default effect I mean the cost of purchasing reserves is exogenous, is given by the international price, but what is true is that yeah, I mean, I would say that the cost of buying reserves is exogenous, but the cost of accumulating reserves is affected by the spread, and this is affected by the choices of the government. So in this sense, the government is able to affect this cost of holding reserves. This is true. And going back to Philippe, and I think it's crucial to talk about this, the very strong assumption about the households cannot make any safe decisions, that households are only hand-to-mouth households. I think it is true that this is a very strong assumption. I will say, and I don't think it's a good answer, but this is like a common assumption in the sovereign default literature, and actually there are like many papers that try to rationalize this under some assumptions. Like, for example, I think about Bocola, Bornstein, and Dobbs, where they show that under some conditions, this is like equivalent to have households that have that have access to financial markets. So I mean, there is some work on that. I think that maybe I need to mention more what are the implications of this assumption. Thanks a lot for the papers. I'm gonna look at them. For example, there is another. Yes.
Perhaps you can interact directly with the commentators, because
yeah. Sorry. I just got excited with too many comments. But thanks a lot. And yeah, I will happy to talk with all of you later. So thanks a lot, Joaquin. Sorry.